Welcome to Energy Unplugged, your go-to podcast focusing on the global energy transition. I'm Oliver Kerr, Oliver's Managing Director for North America. And today I'm delighted to be joined by Andrew Flanagan, CEO of RWE Clean Energy. Now, I'm sure RWE will be familiar to many of our listeners. It's one of the biggest power companies in the world. In fact, regular listeners may recall we had global CEO Markus Kreber as a previous guest on this podcast. In the United States, RWE Clean Energy, led by Andrew, is the third largest renewables business in the country, with around, I think, 10 gigawatts of operational wind, solar, and storage. Before moving into the CEO role, Andrew spent a couple of years as Chief Operating Officer, so he knows the business inside out. That's off the back of 25 years of experience in the industry, including previous leadership roles with Leeward and Invenergy. So plenty of experience developing, constructing, financing, and operating generation projects across the US and indeed globally. So Andrew, we're delighted to have you. A very warm welcome to the podcast.
Thank you for having me, Oliver. It's a pleasure to be here. And maybe just to note, today's an exciting day for us. We just released a press release as we've tipped over the 10 gigawatt operating mark, of generation assets here in the U.S. So something we're very proud of and excited today.
Fantastic, huge milestone. So to kick off, and I asked you this when we spoke a couple of months back at Aurora's Energy Transition Forum in New York, and I think I'll ask it you again now because it's a good place to start. So you spent a good chunk of your career focused on the US power sector, but you also have this global expertise. So I'm curious, what makes the US a particularly attractive market from a power generation supply perspective? Is it the market size? Is it the fundamentals? Is it policy or regulation? Is it all of the above? What makes it so attractive?
Yeah, I think it is a very much a function of all of the above. The sheer size of the market makes it very attractive for us. I would say overall, RWE has a pretty disciplined approach to diversifying across its portfolio and across everything that it does. The U.S. represents a tremendous opportunity for us to diversify across technologies, resource, market archetypes, offtake structure, and the like. And then I would say the overall regulatory policy and namely the IRA, provides a, very long-term stable investment environment that in a lot of ways, we benefit from. And in some cases, my European colleagues are very envious of the support structure that we have. And mostly it's the clarity, the incentive-based approach and the long-term duration that provides a lot of stability to the investment opportunity for RWE in the U.S. So the U.S. market is a huge market for RWE, and fortunate to have the opportunity to lead this great business.
But of course, the U.S. market isn't a monolith. Certainly, Aurora discovered that when we first moved over here. I think you touched on it in geographical diversification. I was checking out the portfolio beforehand, and I think you're across 24 states, lots of different power markets. So when you're thinking about capital allocation and diversification, what makes a market more or less attractive? What states or markets are particularly attractive to you, or does it just depend? You follow the opportunities wherever they arise?
Yeah, I think the key difference in what we've seen here is there's opportunities everywhere. As the load growth has been so tremendous, the need for new generation, you've got growth opportunities available in all different markets. I think at its core, RWE truly understands and operates effectively, in markets with good fundamentals. So we always have a preference towards more liquid markets. We have a significant energy trading and risk management operations, that we operate globally, and we understand the markets and we believe in those markets. So we like the markets, the PJMs, the ERCOTs, the MISOs, those with more liquidity and good, strong market fundamentals. But we also like to balance it across the diversification from this. So, markets, that are more regulated and where you're looking for offtake that is longer duration, may have lower returns associated with those, but greater stability with those. We like to really balance it across those markets as well. So we do take a very balanced approach. If you look at the portfolio for us, it's about 55% wind, 45% solar, 5% storage, and growing. As I mentioned, we're at the 10 gigawatt mark here at this point. We have 4 gigawatts under construction, in which we've taken investment decisions on that will come online across the next 2 years. So that's exciting growth and a little bit more heavily weighted on the solar side of things. But we maintain a good balance on wind and diversification across the U.S. and those markets.
It's interesting that the focus of the under construction assets is more weighted heavily towards solar than towards wind. I think it's interesting. We see the economics of wind, onshore wind, that is pretty bullish across different U.S. markets, but we're seeing less of it get built than perhaps the cash flow models might suggest. What do you think is driving that, and to what extent is that reflected in your investment decisions also?
Yeah, I think what you see is a couple of reasons why you see more heavily weighted towards solar than wind. One, pre-IRA, we were coming off of a prior ITC PTC scheme where we saw the PTCs for wind and it being dedicated to wind only tailing off. And then you still had the solar ITC was tailed off at a later point in time. So for that reason, you saw more investment to that. You also were really making the most headway from a cost perspective on the solar generation side of things. And there was a period there where it was much more cost competitive there. And then at the time, the saturation, on wind was more saturated. So you had more opportunity, more demand, more need for the solar, which also has the greater time of day benefit associated with it. But what we've seen is now the market has shifted. One, load growth has been tremendous across that. So the demand for energy, regardless of the time of day, has increased significantly. But we still have the challenge with developing wind. It takes a lot more land. It's more challenging to develop it. And let's be honest, I think, people tend to go to where it's a little bit easier to develop and you can get more of those investment opportunities. I think RWE we've maintained a very good balance and focus on the wind side of things. We specifically have 2 projects under construction, right now in ERCOT South Territory, 440 megawatts. With offtake going to Microsoft for those projects. So we're very excited about the generation and the balance we have still with the wind, and we want to be, continue to be a leader in that front.
It'll be interesting to see how or if the pendulum starts to shift back a little bit, despite some of the challenges you raised, as more solar comes online and you start to see some of those saturation effects that we're already seeing in markets like CAISO play out elsewhere. I think we're starting to see that a little bit in ERCOT now, and wind's production profile in some ways makes it a slightly more hedged asset from a revenue perspective.
Yeah. I mean, if you look at it, that pendulum's been swinging quite a bit
right.
to maintain that. I mean, it used to be that you couldn't get an offtake in ERCOT West. Right. I mean, there was just zero liquidity for that. And the electrification on the oil and gas side of things has really driven up demand and brought that about. Across PJM, you saw that line. You used to be able to draw a line where solar would dominate versus wind, and bad factors of where costs have moved on the solar front, but also the demand and the value of the sheer volume of energy that you get has really moved that needle. So, and I think that's kind of the benefit of RWE and our scale and maintaining that the commitment to the technology is to have those opportunities as the market shifts, and that will hopefully be poised to capitalize on those.
So you've touched on load growth a couple of times now, and I think it's a topic worth diving into because it's getting a lot of airtime in the United States right now. So we've seen some astronomical forecasts out there for load growth, based, among other things, on data center demand. Now, from a system operator from a system reliability perspective, this is often framed as a threat or a challenge to reliability. From a generator perspective, though, clearly it's a big opportunity. So my question really to you is, how much of the load growth do you think is real? And to be more specific, when you're making investment decisions, taking a forecast to investment committee, how much of that load growth are you really factoring in there?
Yeah. Oliver, you always, you've cited on a couple of occasions, I don't know if it's geared towards to me and RWE, that ERCOT is forecasted to add essentially the size of Germany system and new demand. So the forecast and the load it's tremendous. Even if a fraction of this gets built or comes to bear, the demand is major and it's significant and it drives this. I don't think it drives as much as our near-term investment decisions as it does our longer-term, growth strategy. Mm-hmm. Certainly the investment decisions, that we take now, we benefit from the strong demand and we're able to secure, good solid offtake for our projects that really anchors the investment decisions. So it creates a tremendous environment climate for us here. And we're able to secure, offtake with very valuable and well-structured counterparties, that allow us to provide the revenue certainty and lock in those robust returns, is that really anchor our growth, across the U.S.
Maybe to flip it around, let's say we're in 2030, looking back, and this load growth hasn't materialized as anticipated. Why would that be? Is it because the demand for power from AI growth is perhaps not as high as expected? Or is it on the power supply side? Is it interconnection queues being challenging? Is it grid constraints? What would cause that demand growth really not to materialize as anticipated?
You always have the risk, and I think as you look at it, we've had a tendency to over forecast, on load growth. We haven't seen this sort of level of load growth even that we realized so far, right? We saw, I think, 5% load growth in 2024 alone over, 2023. We've never, it's been a long time since we've seen that, probably late 90s on that. We're used to very much stagnant load growth. And I would, we're not, I think we're having to adapt to how to adjust to that load growth and build and deliver on that. So I think we could see, the overstated on the data center demand and AI, and that could result in lower actual load growth. And then there's the question of, can we provide the power? Can we provide the electricity to enable that? I think we hear that a lot from the ISOs and the states is, it'd be great if you could pair and partner with the new load coming on and to come to us, with not only the demand, to access the grid, and add load to this, but come to us with a new solution for the generation. And I think that, if we can get that right and accelerate the onboarding of new generation assets, navigating the grid and the constraints that exist there, build out the significant infrastructure that's needed, we can avoid a lot of, curtailment or curbing of that load growth, due to the constraints around the supply side of things. But that's the huge challenge and one that we're really excited about, right? And that's essentially, our target on this is to be there with the energy now that we need to really grow, at the rates that are projected.
On that constraint on new projects coming online, one of the other big challenges in the US right now is simply interconnection queues and the challenges that system operators are having getting through those in a timely manner, and occasionally the self-imposed levels of the link to system reliability that needs to be shown for a project to get through that interconnection study and get connected to the system. How much do you see this as an issue, in different parts of the country? And, NERC has just put out its reliability forecasts. They're sounding the alarm again as they want to do. Is there a meaningful vision of the next 5 years that sees, the lights going out in different parts of the state, or is it we're not that dire yet?
Yeah, I'll leave that to our colleagues at the RTOs and the ISOs in the states to forecast the reliability and those constraints. But I think the interconnection queue and processing of that is going to be a critical part and probably one of the most significant challenges that we face, even greater than some of the changes that are expected with the new administration. We have a definite need for dispatchable resources, capacity resources, right? I mean, the base load increases that are coming on. These new loads that are coming on are around the clock, and they're major, huge load growth. So we'll need more dispatchable resources. The renewables, the investment climate has been robust, and we've attracted a lot of capital into the U.S. that has really filled up a lot of the queues. They tried to raise the bar, increase the pay to play, into those queues. The market responded, didn't back down. It continued to submit applications. I think, MISO, if you look at it, I think it's roughly 350 gigawatts in the queue. About 93%, I believe it is renewables. Roughly 5% of it is thermal, and the remainder is other. There's a significant gap there, right, between what's needed for dispatchable resource and what's available there from a renewables perspective. So we're going to have to do something to bring forward, make sure we get the dispatchable generation is available. We can't ignore that, but in the same breath, we need to make sure that those projects that have been there developed, put capital at risk and made the commitments and are ready to be constructed, that they get that fair treatment for that, because they can be a huge part of the solution. There's, taking that MISO case, significant amount of that 350 gigawatts that can be constructed now. And we sit on a large pipeline, within MISO ourselves, and are poised, ready to construct that, fully permitted, fully engineered assets that we're only waiting on that interconnection. So we've got to make sure we work through that and bring those assets online, at a more rapid pace than what we currently are.
And you can punt this one if you like, but are there changes that you would like to see, whether it's in a market like MISO or just more generally, that could start to unlock that ready-to-build capacity and let it come online quicker?
More of the connect and manage, where the approach that ERCOT, where we take on more of the risk, in terms of that location, and whether we'll be congested, I think would be that one piece of it. And I think on the more minor level, I mean, that would be a fairly significant shift on that. But just putting, in general, whether it be us building more and more of those facilities, being in a position where we take on more of that limited operation risk until various network upgrades are done. I think that would be other quicker fixes that could allow us to come online and bring the value of that. And I think we're happy to take on that risk. We understand that we can manage that energy resource risk and really drive more investment.
I think it's a really important topic. Listeners may want to refer back to our episode 223 a few weeks ago with Tyler Norris. He's an expert on the topic of interconnection across the United States, and I think it's a good one if you would like a deep dive on the topic. You touched on the thermal generation piece. How challenging is it to build new thermal assets in today's investment climate?
Our RWE is not developing new thermal assets. I mean, we're well aware of it and evaluate in the U.S. That is
right.
I think there's a few things though that create challenges. I mean, there's a lot of projects that haven't been under development, right? And they're playing catch up. So you've got to get through the entire environmental permitting process, and there are major obstacles associated with that. Then you've got the lead time on equipment as well, which understand is starting to push out to 27, before that equipment becomes available. And then you've got the construction period there that's 2 to 3 years across the combined cycle as you get all the way fully through the commissioning process as well. So you start to look at new resources that are coming on more in the 29 to 30 timeframe. So, but we need the energy now, right? I mean, the investment opportunities where is immediate. So I think there's that. That's really where the opportunity is on a lot of the renewable generation, because the development work, the investment has been made, to have that ready to go. We've been anticipating this. We've been out there securing long lead time electrical equipment, transformers, breakers, everything that will enable that construction, and the equipment, and the investment that's been made, by industry and bringing in new manufacturing into the U.S., so that we have more and more robust, reliable supply chains here that's domestically produced. We've invested, $500 billion into the U.S. since the IRA, 42, manufacturing facilities operating, and another 120 roughly that have been announced. So the investment's been made there, so I think that the challenges that exist on the thermal side of things, there's a great opportunity there on the renewable side of things that can deliver the energy now and maintain this tremendous momentum that we have in the market.
Sure. And if you look at last summer in ERCOT or even this summer to some degree, it's a combination of that solar in the middle of the day and then batteries to pick up in the evening that's really made a big difference. And those assets have all come online in the last couple of years.
Yeah.
I mean, I'm curious, the US is an extremely competitive market right now. There are lots of folks trying to develop, own, operate assets. How do you see the market shaking out over the next few years? What are the sort of key capabilities or sources of competitive advantage that you think will make the real difference?
I think a few things. One, scale is becoming more and more significant at this point. We talked about it. The cost to play in the interconnections has gone up significantly. So you have to have that significant capital resources in order to play in that. And then it's also the cost of that capital has increased significantly. So having the large, efficient financing vehicles, that provide a more cost-effective position are extremely important. And then you look at the lead times. As transformers, get 4 to 5 years out, breakers, in some cases, there's certain breakers that they're not even taking orders on at this point. So you have to be able to make those significant commitments, and to position the business to achieve that growth. I think those are, so that element of scale is critical. We always have to, but while scale is important, if you look at this market, some of the best assets that have been developed, the best opportunities come from, very creative entrepreneurial mindsets, right? Where you can navigate, you have to be nimble, you have to really be able to solve some of the unique development challenges that come about. So I think there's always that opportunity. And if you can pair that, right, maintain that nimbleness, really understand how to partner across the industry and solve those challenges, it can be a huge competitive advantage when you can pair that with the scale. And then lastly, I think it's just the competition for labor and, really the construction resources that are needed to grow and differentiate ourselves. And that's something where, we create partnerships. If you look at it, everything we do is a partnership that we're going. We go in, we build partnerships within the communities, with the landowners, with the communities. With those that are hosting that major infrastructure, we're creating partnerships with the OEMs, the equipment suppliers. Well, we got to create, partnerships with the construction companies, that are pulling together the labor, which is a more and more scarce resource, with the expertise to build that. So those relationships, having that robust pipeline, and that certainty of execution, can be a huge competitive advantage, as we look to grow, and something we're focused on, and really being that strong partner there.
Hmm. I think it's a really interesting point, especially around the scale versus flexibility and nimbleness. I think this goes for all organizations, but how do you think about that going forward? Is it that there will always be a role for smaller developers who are deep in the weeds of a given market and picking the right nodes and transformers, and then they flip on the projects to larger players with scale, or how much of that do you want to just bring in-house, within RWE?
Yeah. I think we look to maintain a strong balance across that. You want to be developing those projects yourself. That's where the margins, you hate to give up those margins, that profitability, and it's something that we can really leverage. We have to constantly monitor that efficiency and effectiveness of that development game, and it's something that I think we've improved dramatically on, and continue to be competitive. We've also maintained, and gone out there and formed a lot of different partnerships across this that, put us in the right position. We announced one earlier this year with White Rock Renewables, a small development arm that we were familiar with, our small development business that we were familiar with the leaders of that organization. And really seen, as an example where you can leverage that strong entrepreneurial behavior, back those, fund those, and we've seen, quickly gone from 0 to 5 gigawatts of development opportunities with them, where we leverage our scale and form those effective partnerships there. We also formed, different partnerships. We announced one just a couple of weeks ago with Peabody, right? So that's not a small, nimble company. Right? That's a large, coal mining business with a lot of history, significant land holdings, and but a partner that was looking to adapt their business, really leverage their land holdings, and to build upon the relationships and partnerships that they have in the communities, where they have a lot of their reclaimed mines. So you got to be creative across the board in formulating these new ways to tackle the market and come up with new opportunities.
Great. Excellent. Now, before we wrap up, we are heading into a new year, heading into a new administration. There has, of course, been a lot written about what the new administration could mean for the energy transition in the US, and flagship policies like the Inflation Reduction Act. At a high level, how much are you concerned when you think of RWE's targets over the next 5 to 10 years about the potential impact of the new administration?
Yeah, I'm not too concerned with that. We'll experience changes, but I think what we do know, and from the new administration, we've seen this before, right? We've as a renewables business, we saw significant growth in our business during President Trump's first term. The growth was greater than it was under the Obama administration. So I think what one of the fundamental principles and that exists with the Trump administration is just this pro-business, trying to drive more throughput, leverage our energy resources, and we're fully supportive of that, and we will benefit that across the industry. I also think the benefits of the IRA have been clear, and it's been clearer across all jurisdictions, and specifically a lot of the Republican lawmakers and the areas that they represented have seen about 80% of the investment. It also benefits all technologies, the IRA. That is, it's not something that benefits just wind, solar, storage. It benefits nuclear, it benefits gas, and I think for that reason, we maintain confidence in that. And then lastly, what really drives all of this is load growth. and the demand for energy. But I think renewables, one of the things I've learned over the past 20 years of working in this space is that it's really been the value of the product that has driven its growth. And I don't think that goes away. The technology's improved, and then when you couple it with a significant increase in the demand for the product, we remain very bullish, despite some of the changes that we'll see, over the next year, that the climate is still very strong and robust.
I think that's generally very well aligned with our view internally also. Do you think that the trend towards domestication or re-onshoring of supply chains will continue in the next 4 years? I think one of the potential changes that we sometimes hear discussed to wind and solar tax credits is, whereas they are now structured as a base rate that everybody gets with then adders for domestic content and adders for things like local community benefits. One of the potential changes would be to require domestic content, require a certain amount of domestic content just to qualify for that base rate. Will that drive further investment, regardless of whether that happens or not in domestic supply chains within the US?
Yeah, I think it's, the incentive has been there. It's been in place for the domestic manufacturing, and the market's responded to that. As I mentioned, 42 facilities operating, another 120, that have been announced or under development. So I think the market has seen that, the benefits of that, and will adapt to that. I think if we shift the incentive, and require more and more domestic manufacturing, the market will respond to that, and we can adapt, and we can formulate the right structures that provide it there. I think what's beneficial here, and I think it's a case for any policy, is that long-term certainty of that. We can adapt. We can, if the rules change, we can figure that out. We can adjust our supply chains. We can adjust our development approach from that. But I think that providing that long-term certainty, and I think that's one of the key value drivers in the IRA and just in general. And that's just, it's just good fundamental policy. And having that energy policy is critical. And then allow the market to respond and act and do its thing, and we'll be there and to drive that for sure.
An optimistic note to end on. Just before we wrap up, one of the ways we sometimes like to end is with a quick fire round of under or overrated. So I'm going to list three things, and you're going to tell me if you think they're under or overrated. I've got a couple on new technology. So, in the context of low growth, we've heard a lot about the potential for a nuclear renaissance in the US. So, nuclear renaissance, under or overrated?
Overrated. I think it's too expensive and will take too long for that. I think it's great, that we've seen the commitments and a lot of those announcements, but to think that we're going to see a renaissance, with the cost and duration of development history is overrated.
Similar one here, and just to I'll make it even more specific. So the potential that we will see 10 gigawatts of CCS commercially operational by 2030.
Well, I'll say overrated again. I think we're making huge strides on the technology there, but the costs are still not proven, and the availability by 2030 to get to 10 gigawatts when we have just a significant need right now for new generation, I think it's going to be a stretch.
And finally, the prospect that the wind and solar, and let's add in battery tax credits, will survive the next 4 years without material change.
Yeah, I think it's probably underrated. They'll be there. There will be. Will they remain unscathed? No. I mean, I think in order to see some of the broader adjustments that we want to make in the tax code, we'll likely see some changes coming about. But again, I think the long-term viability and the benefits of the core elements of the energy components of the IRA will be there, and we'll continue to see a robust investment climate for us.
Yeah. Yep. Energy transition is here to stay. Well, that's a great place to wrap up. Thank you, Andrew. It's been a pleasure as always. Really appreciate your time coming on the podcast.
Yeah, thank you, Oliver. It's always a pleasure to speak with you.
That was Andrew Flanagan, CEO of RWE Clean Energy, talking to Oliver Kerr, Aurora's Managing Director for North America. Thanks for listening to Energy Unplugged. Do keep an eye on our podcast feed for more in-depth conversations with senior members of the energy industry. The best way to do this is to follow or subscribe to the podcast via whatever platform you use.